more signs of a rapidly growing crisis. Is this payback for debt-fueled growth? And so this is what a day of reckoning feels like. Already down 23% from its October high, the Dow Jones Industrial Average is now at a 2-year low. And the Labor Department now says that wholesale prices are rising at their fastest pace since Ronald Reagan's first year in the White House. And automaker and American icon General Motors suspends its dividend to stockholders. And the last time that happened in 1922. In Washington, somber statements are coming from both ends of Pennsylvania Avenue. In Capitol Hill, Federal Reserve Board Chairman Ben Bernanke has warned lawmakers the economy continues to face many difficulties. If it wasn't clear enough before Tuesday, it is now. This is no ordinary economic crisis, and it won't be over anytime soon. And these are not normal times at all. And in fact, in reality, problems are multiplying rapidly. Just a year ago, the financial virus seemed confined to subprime mortgages, defaults on loans given to those with less than perfect credit. But now, much of the banking system appears rickety, and the U.S. economy has slowed to a stop or to a crawl. But thanks to robust demand from still growing countries such as China and Asia, India, the prices of commodities from oil to food have soared, are rising rapidly, hitting Americans from the gas pump to the grocery checkout. And there's no hope of an early recovery at this point, says an economist at Harvard University. The best case scenario is that we have a long but mild recession. And that's the best case scenario. But actually, it could get much worse than that, because there's more things to come, or that will be happening. The root of the economic problem remains the fallout from the imploding housing bubble. Houses, I guess, became just too expensive for the majority of people in this country. Overpriced homes. For nearly a decade, consumers grew accustomed to the idea of ever-rising home prices. Housing-related prosperity boosted consumption as consumers tapped home equity loans for cash to pay for everything from new cars to college for the kids. As the boom roared on, or the illusion of a boom, regulators stood on the sidelines, convinced that the magic of the market would sort out any problems, theoretically, supposedly, once again. And it seemed much too good to be true, and it was. Absolutely. Nowadays, or today, is payback. Now, the economy has a hangover on that order, they say, and the recovery will take time and be no fun. And, yes, it's worse than that. Bernanke underscored the complexity of the task facing policymakers in his Senate Banking Committee testimony Tuesday. The Fed chairman told the lawmakers that the central bank is grappling with significant, or actually major risk, that the economy could slow more than expected, even as the odds of higher inflation have intensified or come true. More new economic data released Tuesday also added to the gloom. Wholesale prices rose a more than expected 1.8% in June and now are rising at an annualized rate of 9% or higher, the fastest pace since mid-1981. Retail sales, however, are just treading water. Excluding gasoline, sales dipped 0.5% last month. Purchases of big-ticket items such as furniture and electronics, and of course automobiles, fell even more. And yes, new car sales are way down by at least 3.3%. The combination of galloping prices and stagnant activity leaves Fed officials with a tough call on any future interest rate moves. If anemic growth were the only problem, the Fed could cut interest rates to jumpstart economic activity. But once again, these are not normal times. There's more to this picture than I would say most people realize. Also, fast rising prices alone would argue for higher rates to cool off the economic engine, but an economy poised to tumble into recession or worse, even while prices are steaming or rapidly rising, leaves Bernanke in one-armed paper hanger mode. On Tuesday, he gave no further hints on his next moves. After cutting interest rates aggressively for nearly a year, the Fed voted June 25th to hold its benchmark lending rate at 2%, citing growing inflation risks. And the Fed's new forecast calls for the economy to expand at a sluggish annual rate of 1% to 1.6%, or perhaps even lower. In normal times, that would hardly qualify as good news. Such weak growth for the world's largest economy would be well below the United States' long-term potential. But that very modest figure represents an improvement over April's outlook. A self-reinforcing recession. Theoretically, the better-than-expected performance may be the result of $91 billion in tax rebates that consumers began receiving in May. That medicine, or whatever you want to call it, will begin wearing off soon, however. And some people say a much-anticipated recession has been merely postponed, not avoided. Forecasters at investment bank Morgan Stanley, for example, expect the economy to shrink for at least 6 months, beginning in the fourth quarter. Actually, it could be much longer. Gross domestic product will expand, if all goes well, by a barely perceptible 1% in the second quarter of 2009. That is, if all goes well. And between now and then, the business pages won't make for any happy reading. The economy is going through what analysts call deleveraging, a fancy way of saying debt repayment. During the housing boom, Americans and their financial institutions borrowed way too much money. And now the bills are coming due, economy-wide, nationwide. Isn't that what they've done to the national debt? Putting everything on the national debit card or credit card. And that's what is making things so tough in so many different ways. It's not like your standard business cycle recession. The trouble with this deleveraging recession is it's very self-reinforcing. Well, a lot of it has to do with psychology, human psychology, and human nature. Anyway, these are not normal times. And these are more signs, the end times, transition days. And there are many signs.